There's lots of conversations about active fund managers being unable to beat the benchmarks, being unable to beat the index. And most of them don't. But one who does and beats it by quite some margin is Andrew Vintcent, who looks after the Lucas Gray Equity Fund. I just want to give you this stat to kick off with so you know where he's coming from. The compound annual return of this fund in the last 3 years has been 23.7%. Just put that in the back of your mind. It compares with the JSE at 12%. So more than almost double what the JSE has delivered. Andrew's going to give us the benefit of his wisdom in the next 20 minutes. Yeah, it's good to be talking with you again, Andrew. And, there's this, I suppose, debate that goes on. It's, well, all value managers, all asset managers are bad, active managers, because they can't beat the index. But of course, in every area, you have exceptions. Now, your performance over the past 3 years is exceptional. Is this something that you've achieved over longer periods?
Good day, Alec. Nice to see you again. Thanks for the introduction. Yes, it has been an interesting 3-year period. I mean, obviously, a number of things did go right for us in that period. To answer your question, the fund's been going for 11 years, of which Grant Morris and I have been managing it together for the last, 8.5 years. It's actually coming up to 12 years now. And over that period, we have been fortunate to outperform the overall market. We look at the JSE Swix as a benchmark, or the capped Swix. I think they're interchangeably one and the same. And over those periods, we have been able to deliver what we would deem to be reasonably good alpha. The last 3-year periods have been a particularly strong period, as you alluded to. I think if you go back 3 years, you're probably coming out of that COVID carnage, if I can use that as a phrase. And subsequent over the last 3 years, we've had a number of things that have worked in our way. Some bigger picture issues, some stock-specific issues, but the net effect has been that the fund has delivered pleasing results.
So I'm sure the obvious next question, if there's a financial advisor watching this, is saying, but how? How did you do it? How did you manage to beat the indices when we are told that it's very difficult for active managers to do so?
No, it's a very good question. So what we actually went back, we had an exercise we did for an institutional client. We wanted to break down the contributors to relative performance. The stocks that contributed most to the active returns. And it was an interesting outcome because of the top 10 largest relative contributors to performance, 7 of those are what we would deem to be mid-cap shares, or in some cases slightly smaller than mid-cap. But the interesting stat to me was that 4 of those 10 contributors were companies that were the subject of a corporate takeout. So they were either delisted. They got to a stage where other businesses or investors thought they were too cheap and too attractive given their potential growth prospects. And it was better for them to take it out at an appropriate price, which in some ways was a vindication of the investment case that we had built around those companies. In other ways, obviously disappointing that companies get delisted. But I think that's the sort of natural evolution of a market that you go through these phases where businesses get very cheap, good businesses get unjustly sold off, and alternative sources of capital come and find these businesses and ultimately delist them. So there's a very pleasing outcome in that we've always told our clients that we have an ability as smaller boutique managers to play across the market cap spectrum. Just given our size, mathematically, we have a wider array of companies from which to choose from. And I guess it's pleasing that of those 10 largest contributors, 7 of those would what would be deemed to be mid-cap shares. Not necessarily all small caps, but certainly outside of the top 40. And I think that's a real, I guess it backs out the process that we've been talking to clients about over the last number of years.
Earlier this week, I spoke with Magnus Hastek and Piet Viljoen, their R1 million challenge. And Piet was saying that small caps are now incredibly cheap. He says ridiculously cheap. They're just being sold down to levels as he's never seen before. Is he exaggerating?
No. To put it bluntly, I actually would completely concur with what Peter's told you. It's quite interesting to me how the psychology of investing is real. We've touched on this before, I think, but I think what's happened has been a sort of acceptance. There's a disbelief initially at the rating at which good businesses trade, and then an acceptance. So if I look at the list of companies that we as a team analyze and what we deem to be an appropriate exit multiple, hypothetically, if a business would trade typically on a 10 times PE multiple, it is now trading at a 7, and there's an acceptance that 7 is the new 10. And in many cases, they're still trading below. So even using 7, you're getting upside. I just think there's a complete resignation or acceptance of the scenario, that the current environment that we're currently in. And you can draw parallels across various parts. So the Rand, for example, is at 19. We just accept that it's at 19. It's very difficult to make a fundamental investment case as to why the Rand should be at 19. Bond yields were high at 11. They went to 12.5 and almost 13 a month or two ago. It's very difficult, and now we just accept that 12 is the new 10, for example, in bond yields. And I think a very similar issue is playing out in equities. There's as I said, there's an initial disbelief at the valuation opportunity. There's excitement around how cheap these businesses potentially are, and then there's a sort of acceptance that that 7 is the new 10, or 5 is the new 8. And I would completely concur with what Fitz and his Merchant West colleagues are saying. I think that these businesses right now are extremely attractively priced. And whilst the small cap index is attractive, I think you can make that argument all the way up the market cap spectrum to a number of relatively big companies too, and certainly in the mid cap space. So I think as investors, we are seeing we use the word in our most recent quarterly, a plethora of opportunities of companies that really are just inappropriately priced for the quality of these companies.
Because of the negativity around South Africa?
It must be an issue. You know, you've had the sort of the perfect storm. You've had load shedding, which we discussed previously, and load shedding is not. It's in the process of going away, we believe, but it hasn't yet disappeared. Interest rates are extortionately high, and you've had a very significant amount of consumer confidence has been eroded on the back of high interest rates, load shedding, and a very weak currency, coupled with a very difficult global backdrop. You know, interest rates globally are very high. Global economy is tough. So I think there's a whole range of different issues that are at play. But certainly this apathy towards South Africa, this apathy towards many of these companies that we've alluded to, I think it's real. But you know, Alec, I think the point to make is, and certainly we're having a number of engagements with companies that we are invested in around this particular issue. So you can bemoan the fact that you trade on a 6 multiple or 5 multiple or 8 multiple if you're a better business. You can bemoan that fact. Or you can accept that and find ways to then unlock the value that the market has presented you with. And I think that is the debate that is increasingly becoming relevant, which is why when I go back 3 years and look at the last 3 years' performance, the fact that 4 of the 10 contributors to performance were takeouts is quite interesting, because that is effectively what we believe will continue to happen unless these businesses don't re-rate.
So all you need really is a little bit of confidence coming back in the system. And if those share prices that don't react would very quickly be bought out by potential predators. Because if you aren't confident about a country's future, you're not going to be buying out businesses unless they are unbelievably cheap. Is that a fair comment?
Yeah, that's a very fair comment. So there are 2 ways that businesses can re-rate. The one is the sort of silver bullet, where someone comes in and buys them out, and you get that immediate kick up kick up of the rating, and you get the value unlock immediately. The other more sustainable one, which I think is the companies we've engaged with are kind of embracing more, is just to do what they do best, and that's to run their businesses. We are blessed, as it's been alluded to on your show countless times, with extraordinary management teams. The environment is extremely difficult, but we believe in many ways it is the most difficult it's likely to be looking forward. Right now, companies reporting right now are dealing with an environment where the Rand cracked, as I alluded to. Load shedding was at level 6 for a sustained period of the last couple of quarters. this is a very difficult operating environment. Interest rates have gone up. I've lost track of how many rate hikes we've had. It must be 350 basis points in the last 18 months. It's a very penal, difficult environment right now. So I think that we are nearing an environment, we think we're nearing an environment where you are closer to trough earnings in companies, and you're trading at these multiples that Pitt and we have alluded to. Multiples that very low relative to history, and earnings base, which is effectively already factoring in all of this negativity and bad news that we've lived through. So I'm not exactly sure when things change. None of us can predict that. We would like to think that the environment that we're reporting in now, the September 2023 earnings numbers, and potentially even to December 2023, is going to be an environment that is as difficult as we've seen at any stage in the last number of cycles, outside of obviously the COVID crisis when things were just things closed down. So yeah, I think that the real unlock is going to come with companies delivering steady growth of this current base, and the realization that they're good businesses, they're deleveraging, their balance sheets are strong, the prospects for earnings are okay, and the rating being applied to them is inappropriate. So I think there's going to be a combination of those. There's no doubt in my mind that some will go, and hopefully we're well positioned in those companies. But the bulk of the re-rating will come just from businesses doing what they do best, steadily growing earnings in a difficult environment. And I think the ultimate catalyst for all of this, outside of Eskom issues, which we can't predict, the ultimate catalyst for this is going to be this continuing rolling over of inflation and the prospects for interest rates to be cut. The consumer economy is well aligned to a lower interest rate environment, and with that comes confidence. With that comes corporate earnings. So I think there's a few issues at play here, but the net effect is that the value unlock story is the potential for value unlock is real.
I guess we all get caught up as well, especially the retail market, in the bad news cycle. Wherever you look, it just appears to be a government that is shooting itself in the foot. It's overspending. It's going to have to increase taxes or borrow more, and the economy is not growing. So everywhere you look, things are really not happy. But by the same token, you can take advantage of any environment. And I guess boutique funds are showing, and we're seeing this with the Corin report, that boutique funds, smaller companies, or more nimble money managers seem to be able to take better advantage than the big companies, where there might be size showing to be an anchor to growth.
Let's be open and honest here. Big companies have become big companies because they are very good. They delivered very good returns over a sustained period of time. So we had enormous admiration for large asset managers. To grow in a highly competitive industry is something to be very proud of. We just mathematically, though, the opportunity set that smaller managers like the boutiques you referred to must have a broader opportunity set. So it's one thing saying that, I think, and that's the discussion we're kind of having at the moment. One thing saying that is another thing is actually to act on that. And that to us is key. So we have a process that spans the whole market cap. We have the whole JSE. So we have, if we look at the 100% allocated in the SA equity fund, we have about 65 to 70% would be what we would deem to be larger cap shares. Not top 40 necessarily, but larger caps. I think it's a cutoff is about a 15 or 20 billion rand market cap. Those would be deemed to be larger cap shares. So yes, we play there, but we also play away from that space into the smaller and mid-cap names. And we think it's our investors will expect that from us. If they wanted a large cap allocation, they would either buy the ETF or pick a large manager who's very good but limited towards a more narrow opportunity set. So yes, I think this ability to play more broadly is why we get quite excited as a smaller boutique by the opportunity set, but mindful of the fact that we're not a small cap fund by any means. We're an investment house that is making fundamental investment decisions on opportunities, but I think our range and our breadth has to be that much wider.
So equities are in a trough. What's to say they aren't going to stay in a trough for a long term? What's going to re-rate South African shares?
I haven't got the exact answer, but my suspicion is the re-rating will be a combination of the issues we alluded to. Firstly, a resolution of the past situation. Secondly, the noise one hears around the urgency at which Transnet is being resolved. And that's obviously those two parastatals are key to the potential growth prospects of the broader economy. But thirdly, I think it's a macro environment in which inflation subsides, interest rates get cut, and you start seeing some economic activity happening on the ground. But I think it's also fair to say that the global economy has not been that constructive for economic activity anywhere, and we as a small emerging market are a victim of that. So the interest rate cycle globally has been brutal. So it's an alleviation of a number of those factors that we think will be the catalyst. But ultimately, as I said, it's companies, even if our GDP growth is modest, which is expected to be by every single economist, good companies have still managed to show a way of growing earnings ahead of nominal GDP. So we think that good companies can still grow modestly, if unspectacularly, at 8 to 10%, and with the potential then for a re-rate. I think the argument that businesses are appropriately rated is fundamentally flawed. This acceptance that a 10 PE business is now a 6 PE business because it's in South Africa, because it's difficult, because there's no power. I think that's a fundamentally flawed argument. We've had very many cycles over time which have proven the fact that that's an inappropriate, that the current ratings are inappropriate. And so now accept, as I said, this acceptance that 5s and 6s and 7s are the new 10s and 11s, we think is inappropriate.
Andrew, we're coming to the end of the Fantasy Fund Manager competition. I've had a lot of fun. I think David Brocher and I we're going head to head in the 700s, and see if we're having our own little competition now on the side. How are you doing in it?
I got up to a very slow start, and I took a slightly more passive approach, if that makes sense, as an active manager, because there's a great quote we use a lot by Tolstoy. It talks about the two great warriors being patience and time. And in the fantasy fund manager, where there is a deadline, patience and time can often work against you. So I've been particularly patient on a number of shares which I know are just fundamentally too cheap. They just may not have re-rated by the time the final gong goes. So I had a very slow start. The second half has been much better. I think I'm coming in the top 50 or 60, somewhere around there. So not too bad. It's been a difficult environment, as David and you have alluded to. But I honestly think that there are two shares I own which we could wake up one day and they could be worth 30 to 40% more. I just don't think it's going to be before the end of the month. I'd like to think it would be, but it potentially won't. So I'm doing slightly better in the fantasy fund manager than I'm doing in the World Cup Super Brew. That makes sense.
And are you able to share those two stocks with us?
Well, the one is Caxton. Caxton has a significant amount of liquid assets on balance sheet, and it has a significant stake in Impact. You're effectively getting the operating entities, which is a printing business, and relatively low growth, steady state, high cash generative businesses. You're effectively getting those for free if you strip out their stake in Impact and cash. And I think that is worth, it's currently trading around 11 Rand. It's probably worth, in today's terms, sort of north of 15 to 16 Rand. And the other one is a controversial share. So, I think our South African financials in general and life assurers in particular are just too cheap. And the biggest one of the lot, well, it used to be the biggest one of the lot, being Old Mutual, I just think is a fundamentally undervalued business for the amount of cash flows these businesses generate. And I think we spoke to the engagements we've had with some of these smaller companies. I think the engagements at a larger company level too is around how do companies articulate the fact that they generate so much in the way of good cash flows. Yes, the growth rates may be modest, but the cash flow generation is not reflected in the underlying share price of some of these businesses. So I think those would be two. And then I think something like a Sasol also falls into the camp where it's just Sasol used to be a standard 10 PE business. It rolled off the tongue. It was always going to be a 10 PE business. It now trades on a less than 5 PE, and that is deemed to be appropriate. And I don't think it is a 10 PE because it's got some structural headwinds, but it's not a 4 or 5. So I think there are a few of those that I own in that out of the 6 that have the potential we could wake up one morning and they could be up 20 or 30%. It's unlikely to happen, but certainly fundamentally, if there was no finish line, which is the asset management industry, we haven't got a finish line. I think that these businesses are ones you want to be owning.
So the new normal is actually temporary, as it always is in your business, in your money management field.
That's a view we're expressing. There are many learned experts who would disagree, but certainly we have to take a view. And what we have done to compensate for the fact that bond yields are higher here than they've ever been in the last 15 or 20 years. So maybe mathematically a PE multiple should be slightly lower. It's the extent to which that derating has happened. So what we do in our models, we're not using the long-term average for a business being 11. We are using 9 as opposed to 11 potentially in certain circumstances. Then I'm sort of using averages here. So we do believe it's temporary. The catalyst for that, as I said, will be businesses delivering sustainably on their earnings objectives, good companies, strong balance sheets, well managed, and that will be it's always the longer term catalyst, if that makes sense. But the risk in the shorter term is that businesses private capital does what they can to unlock value. The companies themselves can unlock value through material buybacks. They all have, the businesses we're alluding to have strong balance sheets, the ability to buy back material amounts of shares. So I think there are a few levers at play, a few levers that companies can play here to unlock what we believe is attractive value.
Fascinating as always. Andrew Vintcent with Lucas Gray. I'm Alec Hogg from biznews.com.